Okay, quick video on our tax system and accounts. So the three main accounts in Canada are the RSP account and all its derivatives. A company pension is a derivative, a RIF is a derivative, a locked-in RSP is a derivative, a LIF is a derivative. There's probably a few more that I'm forgetting. But they all operate the same way, and that's important to know. Then the second account is the tax-free savings account, and the last account is a non-registered account. A joint account is a non-registered account. A bank account is a non-registered account. You can have an investment account that's a non-registered account. So these are the three main accounts. What accounts am I ignoring? I'm ignoring the registered education savings plan. That's got specific purposes. That's to fund your child's education. There's the registered disability savings plan, relevant to people who have children or people who are disabled. There's the corporate account. I'm ignoring that. And there's probably a couple others that I'm forgetting offhand. But these are the three main accounts: the RSP, the TFSA, and the non-registered account. So I want to run through a broad overview of each account. And before I do that, I'm going to minimize my face. Okay, so the RSP account. The features: money coming into the account reduces your taxable income. So that's the first benefit of the RSP account. Money leaving the account is added to taxable income. So if you redeem from your RSP or from a RIF, it is going to increase your tax bill. The third feature is there is no tax consequence, no immediate tax consequence on activity within the account. So if you get interest income, or if you get dividend income, or you sell an investment within the account, as long as you're not taking the money out of the account, there are no immediate tax consequences. There is the tax consequence of passing away. If you don't have a spouse and you pass away, the full balance of the account is added to your taxable income on your final tax return. And with an RSP, you're able to choose a beneficiary. This is important. By choosing a beneficiary, you avoid the whole probate process, and it doesn't go through the will process. Okay, so that's a broad overview of the RSP account. The tax-free savings account is easy. Sorry, let me back up. On the RSP account, all money in this account is money that you have never paid tax on. You may have paid off your paycheck at work, but when you did the RSP contribution, the government said, we've overtaxed you, and they gave you the tax on the amount of that RSP contribution. So ultimately, money in this account you've never paid tax on. And you pay the tax when you do the withdrawal. Now, the tax-free savings account. There is no tax consequence or no tax benefit to contributions. There is no tax consequence to withdraw. There is no tax consequence on activity within the account, and again, you're able to choose a beneficiary. So a few words on this. Okay, so money in this account, you've paid tax on already. If you make a $5,000 contribution to your TFSA, the government does not say, hey, here's the tax back on that $5,000 that you earned through your employer. They don't say that. So that's money that you've already paid tax on in this account. No tax consequence to withdraw, or no tax consequence on activity within the account. If it's an interesting account. If you make a magical investment, you put $1,000 into your tax-free savings account, you invest it in something, and it goes up 1,000,000%. As a ridiculous example, where would you want that investment? In your RSP, in your TFSA, or in your non-registered account? You would want that investment in your tax-free savings account. Ultimately, in the RSP account, even though you don't pay any tax when you sell the investment, once you start making the withdrawals from the account, well, you're going to pay tax. This is the account in that scenario with the magical investment that you would not pay a single cent of tax. Now, the non-registered account, so the tax-free savings account, the only drawback to it is you can't contribute that much. I think it's $6,000 per year now. Now, if you don't use the room, you don't lose the room. So if somebody has never put a dollar into a tax-free savings account, I think right now in 2019, they can plunk in $60,000. It's over 60,000, but under 65,000 right now. So the room that you didn't use in 2011 or 10 or 9 is still available for you. Now, the non-registered account, this helps make the other accounts clearer to understand. There is no tax consequence to a contribution. So all money in here is money that you've already paid tax on. There is no tax consequence to withdraw. However, everything in here that happens in this account is taxable. So let's look at a few things. Let's assume that someone has $50,000 of income and they're in Ontario. It works the same in all the provinces. The brackets will be a little bit different and the marginal tax rates will be a little bit different. But let's say in Ontario, person has $50,000 of taxable income. So here's the scenario. A resident of Ontario is working, they earn $50,000 a year. Their marginal tax rate is 29.65%. Okay, they get $1,000 of interest income. What does that mean? That means the government taxes away $296.50 of that $1,000, and they get to keep $703.50. They get, here's the next scenario, they get $1,000 of dividend from a Canadian corporation. So that's this rate here. Tax is $75.60. They get to keep $924.4. They get, here's the third scenario, $1,000 of capital gain. So they buy something, let's say they put $1,000 into the account, it grows to $2,000 by capital gain. It grows quickly. The stock doubles. This is the rate on that, 14.83. They pay 148.3. They get to keep $851.7 on that $1,000 of capital gain. If they get $1,000 of dividend from a non-Canadian company, it's the same as interest income. So they get to keep, or they pay 29.65% and get to keep the balance. So it doesn't matter that you withdraw. It matters what takes place within the account. If you have, like, here's kind of the nightmare scenario in the non-registered account, is that you invest in a growth investment and it does really well, and you kind of want to sell it now. Well, you've got a big tax liability that's going to instantly trigger when you go to sell it, and that prevents a lot of people from selling. This happened to Nortel employees quite some time ago. They had a pretty big balance of Nortel stock in their non-registered account. They probably wanted to sell it, but they knew that it came with a pretty big tax liability, and they probably put off selling it, and then Nortel went to zero. I'm sure they wished they would have sold it, but it's a little bit painful triggering that big tax bill by selling it. Tax consequence of passing away, all unrealized, untriggered capital gains get triggered when you pass away, and the bill is paid on your final tax return unless you have a spouse. The investment can be transferred to the spouse with the same unrealized capital gain. Now, when the spouse passes away, there's nothing you can do about it. The gain gets triggered. And also, within a non-registered account, there is no beneficiary. So this money goes through the will process and the estate process. Okay, so I'm going to leave it there. So, I would say it's pretty obvious. that if you have investments and your tax-free savings isn't full, or if you're saving for retirement, it's pretty obvious that you shouldn't be holding these investments in a non-registered account. I've got a few other videos on the benefits of the RSP account. If you're saving for retirement, it is hard to argue against the features of the RSP account, and that money should likely be invested in an RSP account. And there's no reason to invest in a non-registered account if you have available room in at least your tax-free savings account. So I hope that helps. I'm going to leave it there. If you have any questions, ask them. Okay, thank you.